Test 1. So the first thing that we're doing is looking at these financial items for Snoop Corporation, and they're going to ask us to prepare an income statement and the statement of retained earnings for the year ended July 31st, 2016, and then they want us to prepare a classified balance sheet on July 31st, 2016. So what I'm going to do when I get started is I'm going to make sure I know what every type of account is that I have So what are the 5 different types of accounts? Who knows them? Anybody? Just say it. If you know it. Name one. Asset, liability. Asset, liability. Stockholders' equity. And what are the other 2? Revenues and expenses. Everything is one of these 2 kinds. Okay, next question. Which ones go on the income statement? All right, revenues and expenses. What goes on the balance sheet? All right, and that's the accounting equation that we're familiar with. Salary and wages payable. What kind of account is it? Liability. How do you know? What's the key word? Payable. If you see the word payable, you know that it's a liability account. Okay? Salary and wages expense. What kind of account is it? Key word is expense. 99% of the time, an expense will have expense on it. Utilities expense is going to be an expense. Okay? Equipment. What kind of asset? Yes. Okay? Accounts payable is liability. Keyword payable. Service revenue. Revenue. Most of your revenues will have revenue behind it, and if not, it'll say sales. And it'll just say sales by itself. Rent revenue. Revenue. Okay? Notes payable. Liability. Common stock. Stockholders' equity. Okay? Cash. Asset. Accounts receivable. What is the key word on that one? Receivable. So you know if it's a receivable, it's an asset. What kind of account is dividends? Oops, I forgot the one time. It's actually, no. It's a special kind of account all on its own. Why? It's not an expense. Dividends is not an expense of operating. We don't have to pay dividends to sell any of our equipment or any of our inventory. Dividends is what we give to our owners after we've made our profit for the period. Okay? It's the amount we determine to give to the owners. So dividends is its own account. Yeah. Rent expense is what? Expense. Okay? So you got to see that we had both rent revenue on this and rent expense. And I'm pretty sure they did that in there to make sure you looked out at that. Okay? And retained earnings is going to be, yeah, it's equity. I'm just going to write that in there. Okay, it's stockholders' equity too. Okay, so they access the first income statement and statement of retained earnings, and then B, prepare a classified balance sheet. What is a classified balance sheet? Anybody know? Okay, classified balance sheet makes sure that we categorize our assets and our liabilities as either current or non-current. Okay, we're going to group our current assets together and make sure we put them all. So let's look at our assets and our liabilities. Salary and wages payable. Is that a current liability or a long-term? Current. Why would you guess that? Exactly. People want to get paid. You will not go long without paying your workers. And it didn't say that it was due in some time period. Asset, equipment. Is this a current asset or a long-term asset? Long-term, yes. We're going to have this equipment for a long time and we're going to use it. Okay, we have another liability. Accounts payable, current or long-term? Current. We know this, accounts just refer to whoever's giving us credit. Okay, and there is nobody who will let you go without paying them more than what? 30, 60 to 90 days, right? Generally after that, that's when they start calling and sending it to collections. Okay, notes payable. What kind of liability is that? long term. You know this because it's 2016 and it says this note payable is due in 2019. Okay? Cash. Current. Yes, it's what we spend. Accounts receivable. Current. Accounts receivable is the goods that we sold to our customers that we haven't collected the money for. Nobody's going to go more than, like I said, 30, 60 to 90 days without trying to collect. Okay? Expense, everything else is an expense, an equity or revenue. Okay, great. Now we can get started on preparing the income statement, statement of retained earnings, and the classified balance sheet. So, first question. What goes on the heading of every financial statement? Name of the company is the first. What's the second thing that goes on? The title of the statement, okay? So we first start off with Snoop Corporation, income statement, and the third thing that you must include in that heading is the period. Yeah, right. If it's an income statement, the period that it's covered, and if it's a balance sheet, the date that it is created on or created for. Okay? So we start that, and we know that we are going to, I don't know if this is going to be net income or net loss. It says net loss, but we'll figure that out. Income statement. Very simply, an income statement is just revenues minus your expenses gives you either a net income or, and we'll find this out, net loss. Okay? So, what kind of revenues did we have? We had service revenue. Do we have any other revenue? Rent revenue. Okay? So in the revenues part, we want to make sure that we include the service revenues and the rent revenues. What expenses do we have? Salaries, utilities, and rent. Okay? Salaries, utilities, and rent. So we should have these three expenses on this list. And you noticed that in the revenues, I had total revenues there. You'll notice that in the expenses, you should also have your total expenses. So the individual accounts are in the left column, whereas the totals are given in that right column for the income statement. Okay? Is this going to be a net income or is this going to be a net loss? Net income. How do we know this? Revenues are greater than our expenses. Okay? Since our revenues are greater, we're going to have net income. Okay? Any questions?
So when the revenue is greater than the expenses, it's what?
Net income. When the expenses are greater than your revenues, it will be a net loss. Okay, please make sure you sign in before you, there we go. Okay. Statement of retained earnings. So everybody got the income statement, okay? All right. So what does the statement of retained earnings have? Anybody tell me? It's what? No, our statement of retained earnings now. Okay, so we start off with our beginning retained earnings. Okay, then we're going to add in our net income. We're going to subtract our dividends, and the resulting balance is our ending retained earnings. Okay, and that ending retained earnings is the retained earnings that we place into our balance sheet. Okay, that's what we're doing. We're coming out with the revenue that we had for this period, right? So we figured out we got $3,300. Now we have to decide. We have to see, did we pay our owners back any money? So we go back, look back, and we look at the dividends, and it tells us we paid $2,000 in dividends. So from what our retained earning was beginning, all right, we had $42,200 in retained earnings to start. Okay, we're going to add our net income. All right, we add net income of $3,300. We're going to subtract the dividends. And the result is going to be added to our retained earnings to get us our ending retained earnings balance. Okay? Any questions?
So if it's net loss, you put it in the subtract column?
I would subtract, not that I would put it in the subtract column, but I would be subtracting net loss. You add a net income because it's more money being added. You've earned money this period. So your retained earnings increase because of that. But if you have a net loss, then you've lost money that period. So you would have a net loss to subtract from whatever your retained earnings are. Okay? Okay? And then from there, we're going to use this retained earnings balance to help us complete our balance sheet. Okay? So just as I said, we have assets. The balance sheet is going to be the accounting equation. Assets equals liabilities plus owner's equity. Okay? And we want to make sure they're all equal. We went in and we identified our current assets to start, our current liabilities as well. So we come down and we say our current assets were what? What were our current assets? Anybody? Cash and accounts receivable. Thank you very much. Okay? So we're just going to list those out. What other assets do we have? Equipment. Okay? And that gives us total assets of $57,980. Okay?
What was the last one? Oh,
Equipment. Okay? Now we have current liabilities. What are the current liabilities that we're dealing with? Our accounts payable and our salary and wages payable. All right? And then our other liability is a note payable. Okay? And it gives us total liabilities. Then we have the stockholders' equity. I'm going to close that up so that there's no gap anymore. Okay? So now we have current liability, stockholders' equity. And stockholders' equity will be our retained earnings, our common stock, and our retained earnings. All right? Total stockholders' equity. And then add up the 49,500 and the 8,480 will give you the 57,980. And we are correct because our assets match our liabilities and stockholders' equity. Okay? Any questions? Oh, scrolling up? Gotcha. So this would be what it looks like all together. All right? Okay, so we're pretty much halfway through this review and we are only used up 20 minutes. So I'm going to go back real quick and make sure that those who came in late understand what we did. Okay? To start, we were given this set of information about the financial statement items, okay? And what I did was I went and I labeled what each item was. If it's a payable, I know that it's a liability. If it says expense, I know that it's an expense. Equipment is an asset. Accounts payable, liability. Revenue, if it has revenue on it, keyword is that it's a revenue. Okay? And then we're going to go back and create these financial statements from our breakdown. We say that we know that an income statement is revenues and expenses. So we list out our revenues first. We total our expenses. We subtract the two to come up with our net income. Okay? And I want to make sure, emphasize, every single financial statement needs to have the heading. It needs to have the company name, the title of the statement, and if it's a statement of retained earnings or an income statement, it needs to be for the period that it covers. Okay? Like this one says for the year ended July 31st. It can be for a year, a month, a quarter, whatever is designated. All right, we have it here. Snoop Corporation balance sheet as of July 31st, 2016. Whereas the retained earnings and the income statement are for the year ended. Okay? Next thing we have to do is journalize these transactions. Issue common stock for $100,000 cash. That was the first one that I showed, and it was already up there. That is, and let me give you the way that I analyze transactions. Okay? When I read a statement, the first question I ask myself is cash affected? Okay? So I read the statement, issue common stock for $100,000 cash. Is cash affected? Did cash go up or go down? So is that a debit or a credit for cash? Debit. That's half the journal entry right there. Why did cash go up? Because of common stock. Okay? And that completes the journal entry right there. So we go and we say cash. I know cash is going up. So I'm going to debit cash for the $100,000. Then the
I'm sorry, I didn't make it up. But if it's a credit, is cash still first, like on the transaction?
you always put debits first and then credits.
Okay.
Debit and then credit. Always left then right. That's debit means left, credit means right. You put whatever's left and then whatever's on the right.
If it was credit stock or common stock would be first.
What do you mean? No, every journal entry has a debit entry and a credit entry. They must equal. All your total debits and your total credits must equal. Anytime you're doing a journal entry, the first thing that goes is a debit. The second thing is your credit. So if cash was being credited, cash would be credited, right, second. Okay? All right. Okay, so we got that? So let's go back to number 2. Purchased $500 of supplies on credit. Is cash affected by this transaction? No. Should it have been, though? It should have been going down, right? But we don't. Instead, we say we're going to put that on accounts payable. Because if it should go down, we're not going to. We're going to put it on account. If it should go down and it's on account, that's account.
What's the difference between note payable and account payable?
A note payable is what you have to sign a promissory note for. Everybody sign a promissory note before coming to college type thing to borrow money? You sign a note. A promissory note. So the difference is note payables are generally longer in duration. Accounts payable, you don't usually sign anything. It's just usually company credit granted to you. Or
What it said, like when it's a note payable, like what's the thing that you know that it's note payable?
in the transaction, you will read it in the transaction. For this class, as it stands, you would read it in the transaction. So when we get there, I'll show it to you and you'll see how. Okay? So purchase $500 of supplies on credit. If you purchase on credit, you're using your accounts payable. Okay? Because your cash should have been going down, your cash should have been getting credited, but it's not. Your accounts payable is. And it says purchase $500 of supplies. So this is just a purchase of supplies. Okay? Supplies will be the debit, and accounts payable will be the credit. Okay? So, as we just asked about with the note, would you like to read transaction number 3 for me?
Purchase the service for $25,000, paying $2,500 cash and signed a note.
And signed a note for the balance. It's generally going to tell you you signed a note. Okay? Half of this accounting class is making sure you read. It's not hard math. We don't ask you to do very difficult math. You just want to make sure you read, understand what you're reading, and journalize it the correct way. Okay? So purchase equipment for $25,000, paying $3,500 in cash, and signed a note for the balance. Okay? So I know that, like I said, I analyze my transaction. I say, is cash affected? Okay? What happened to cash? It goes down $3,500. Okay? Now, why is it going down? Because I what? Bought equipment. Is the equipment $3,500? No, the equipment is $25,000. So the difference between what I get for the equipment and that cash is going to be credited to the notes payable. I don't know what the difference is. 25,000 minus 3,500, like 21,500, something like that. See, we use nice round numbers so that the math isn't hard. All right? It's like $25 minus $350. Anybody can give change, right? Okay? But you just want to make sure you understand how to do an analysis of the transaction. Okay? So that was number 3. Number 4, paid $250 cash on account for office supplies purchased in transaction 2. Okay, so did my cash go down or up? Down? Okay, cash went down, then I'm going to credit cash. So that means cash will be the second item, right? Because we're crediting it. Okay, so we said paid $250 cash on account for office supplies purchased in transaction 2. So what happens is, if we look at transaction 2, is we purchased $500 of supplies. And rather than paying them the money, we said, we'll pay you later. Just give us, take my word for it. And then we come back and we honor that word so far, right? Because we bought $500 worth, but we only paid them back. That's fine. It's just business. You're just recording what happens, okay? I bought supplies, $500, I put it on account. Then sometime later, I went and paid $250 of that account off. Okay? All right. That's the fun one. Number 5. Everybody got number 4 down? Okay? And you'll probably be able to take a picture when I'm done, when I just scroll down and you all just take a picture and you'll have it all with you with photographic memory. Number 5. Paid rent of $9,900 for the months of August, September, and October. So, what's the journal entry? Okay. Cash should be credit, because if you get confused, like I said, you always start off with cash. Okay, if it goes up, if it goes down, you'll know whether you debit or credit it. So here you say, I paid a rent of $9,900 for the months of August, September, and October. Well, did my cash go up or down? My cash went down. Why? I'm paying rent for these months. It doesn't tell us when the month is that we're in, but we just assume that this is in the future. If it tells you for the months of August, September, October, and it doesn't say that we're in the month of August, then you know that it's all about future payments that you're making, which is a prepaid rent. Number 7, performed services and collected $1,200 cash from customers. Is my cash affected? Did it go up or down? So is that a debit? Oh, wait, 6? Oh, I'm sorry, skip 6. Paid $2,500 for salaries in the current period. Okay, did my cash go up or down? Down. And so you see how it says paid $2,500 for salaries in the current period. Salaries in the current period is what? Is an expense. Okay? Is a salaries expense. Okay? You would have known if it was a payable account because it would have said paid off salaries owed from the previous month, period, etc. When it says paid salaries for the current period, that is salaries expense and the credit goes to cash. Okay? Okay. Now we can move to number 7. All right. Performed services and collected $1,200 cash from customers. Okay, so our cash went up. So we're going to debit cash. What's the reason for debiting cash? Because of accounts receivable. Because of services. So if it's services, because we perform services and we collect it. You see? So our cash went up because we perform services. So it's what? Cash is the debit. What's going to be the credit? Why? Service revenue. Right. Not services, but service revenue. Okay? Key word that you read there that tells you that it's revenue is what? No. Okay, thank you. Performed. You performed. Okay? Anybody remember the revenue recognition principle? Chapter 3. Expense recognition principle. Same chapter. Okay? If we're doing accrual method, the revenue recognition principle says you recognize revenue when they have been earned. Revenues are considered earned when you have performed your duty to your customers. and you can expect to receive payment. So the minute that you are done performing the service and you expect to be paid for it, that's when the revenue has been earned. Okay? So when you see this, it says number 8, perform services and bill customer $750 on account. Did my cash go up? No. No. Should my cash have gone up for performance services?
Yeah.
Right, it should have, but since it didn't, I know that I need to open up and,
Credit.
yeah, I credited somebody. I need to open up an accounts receivable. Okay? I need to debit account receivable for that cash that should have gone up. Okay? And it says perform services, so I know that's because of service revenue. Okay? Because what? Somebody said services was the key word, right? And then when you read 11, you're going to see why. So number 9, collected $750 from a customer on account. Okay? So we just did perform services and billed the customer $750. So here, does our cash go up? Why does our cash go up? Because we're collecting from a customer. So collecting from a customer tells us to credit accounts receivable. Okay? So what happened in 8 is we did the service for the customer. They told us they'll pay us next week. Customer came next week, paid us all their money. That's what you see in those 2 transactions. Number 10, borrowed $15,000 cash from a local bank, payable in 3 years. Okay, here's another hint that it's going to be a note payable. You cannot borrow money from a bank without signing a note that you will pay them back. All a note is saying that you signed a paper that said you will pay back. You don't do that for normal business operations, but if you need to borrow money, somebody needs to know that you're going to pay them back. When you borrow money, you generally have to sign you'll pay them back somehow, some way. Okay? So, borrowed $15,000 cash from a local bank. Was my cash affected? Did it go up or go down? Up by how much? There we go. Cash gets debited $15,000, and because it says we signed a note, then it would be note payable for $15,000. Okay? All right. We're at our last question. Do we have any questions before this last question? None at all. All right. 6. Somebody said 6 something? You have a question about 6? 6 is paid $2,500 for salaries in the current period. Okay, so we know we paid $2,500. So if our cash is affected, our cash goes down. Okay, and it's for salaries in the current period. That means that's now happening, that we're incurring it. That's salaries expense. Okay? And then, last one. On the last day of the month, received $1,300 in advance for services to be performed during the following month. You see it says, okay, we got cash, right? We received cash, so we're going to debit cash. Why? What? Yeah, that's what debit for cash tells me. Yes, but what reason did my cash go up? Hold on. It didn't. All right. Hold on. Let's get this. All right. So I received an asset, correct? Did I decrease another asset to receive this to increase this asset? No. Did I sign a note? So did I increase my liabilities to receive this? No. Okay. You sure about this one? Okay. So I don't owe anything for this money that I received. I owe services. So I owe something. Huh? Unearned revenue. Thank you. You see what it says? I received $1,300 in advance. I received money. Did I do what I'm required to do for it yet? No. Then that means I owe somebody something. I owe. That is a liability. Okay? So. And that is the one liability that confuses most people, is unearned revenue. Okay? So the key that you read is that you received money in advance for services to be performed. Well, I got paid before I did what I have to do. So that's not technically revenue for you. That's money that you owe that you have to perform on, and then you can consider it revenue. So if on the last day of the month you got this money, for this month it's a liability, but then what happens next month when you pay it off? What's the journal entry going to be? What's next month when you earn it? We got a debit and a credit for everything. Debit and a credit. Debit and a credit. We are going to earn this revenue from last month. We earned the $1,300 in revenue paid in advance to us last month. How do we do the... So what? It's a debit and a credit. Every journal entry is a debit and a credit. You have to know what gets debited, what gets credited. Here let me type out what it is. So let's say number 12 says performed services that you were paid in advance in the previous month. Something like that. You performed services that you were paid $1,300 for in the previous month. How do you journalize that? Is my cash does cash get affected? Yes, how? Did I collect cash? I collected cash? Right here is what it's telling me. Where does it say I collected cash? Where? I already collected the cash. I'm talking about, I already did that journal entry then. Guys, I've done that journal entry right here. Cash, unearned revenue. I've got the cash. I don't need to record that I've got cash again because I've already got it. I know that. My question is now, I performed services for $1,300 in the previous month. What's cash affected? Yes or no? No. What did I do? I performed services. What does that mean? Service revenue. Thank you. Okay? If I perform services, service revenue, is that a debit or a credit? Credit service revenue. I performed service that I was paid for $1,300 for in the previous month. Previously, I recorded cash and unearned revenue, right? Because I recorded the liability. Am I complete with the liability? And here's a typo. It says 13,000. It should just say 1,300. It should just match whatever is up top. I think it said 1,300. Yeah, it says 1,300, so this should be 1,300. That's just a typo. Okay? I owed them $1,300 worth of revenue. Did I complete my revenue for them? I've done what I've had to do. I performed my service for them, correct? Okay, so then do I still owe them $1,300? No, then I need to do what with that? Take it off. Right, and it's a liability, so I debit that. And you can see what it is. I received the cash, I owe them the revenue, I performed it, so now I can consider it revenue. That's the two journal entries, how those two go. Okay? So always ask yourself what's going on in the transaction. Is cash affected? I performed services. There's no cash there. That you were paid. I was already paid. There's no cash there. It's just telling us the value of the services that I was paid for. Everything in accounting, if you look, is about dollar value. We record only dollar values. We don't care how many shares of stock you sold. We don't care how many pieces of equipment you bought. Equipment has a dollar value. That's what we're accounting for. You bought 30,000 pieces of equipment that cost $25,000. Well, the only thing I care about is that $25,000. Okay? So everything that you're going to read about is talked about in terms of the dollar value. But you don't confuse it by reading something that says 500 and just thinking that it's $500 cash. That's where you make a quick mistake from. Okay? Just reading a number does not mean that cash is involved. Hello? Okay? No problem. Anytime. I'll be here every month doing this. So our next test review will be October 11th and 13th. Unless, is anybody taking managerial at the same time they're taking financial? Great. Smart people.